What is going on, everybody? It is Mark Rossano and David Ramsden Wood here for your pregame show to get you set for all of the data that's coming at you this week. And I am surprising Mark. I haven't told him any of the questions, which is actually fairly usual for us, to be honest, because I could ask him about like what is the temperature of the sun, or like what is the economic inflation in Bulgaria, and he would know the answer without any pre-work. So that's why we love Mr. Rossano. Mark, how are you today?
Pretty good. You know, looking at the markets recovering a bit from yesterday's fall off, and just the usual volatility that we've grown to know and love is always some good times.
It's incredible. I had this. So I'm long energy. As you know, I was very not wanting to be long energy for a very long time. I jumped on the train, and thank goodness that I did. And every Monday, it seems like energy stocks want to rally. And so last Monday or 2 Mondays ago, I did a little trade. Totally backfired because the rest of the week, it only went up and to the right and oil hit 66. And then this Monday, I said, well, it's going to keep going up. It opened way up and then everything tanked yesterday. So it's like, it's so hard to discern. But today where I want to start is Cathie Wood and ARK and the tech fund, and I'm going to tie in a little Chamath Pipalapalapalupala with his SPACs, because this momentum trade, this tech trade, this zero revenue trade seems to be what's driving the market, and if we have a rollover, boy, it seems scary. So I wanted to get your take on it, given that it was in the news this week.
So let's just start with ARK and Cathie Woods and what does it mean so far. So when you think about what do these companies need to survive, as you mentioned, they make no money. There's a growth stock. There, if you build it, they will come type situation. But when you consider where yields are going, where inflation's going, their weighted average cost of capital or WACC is going to go up, because you're looking at something where as people start to price this more off of a rising risk-free rate, if we look at the 5-year through 30-year, you're going to get a natural move up in a lot of these yields. And not to say that people won't want the paper that they're going to be putting out, but you're just looking at just the inherent interest rates are going to go up and their costs are going to get weighed down. Now, when you consider how illiquid some of these stocks are, then you start to come into a structural problem, because when you think about how weighted she is in some of these illiquid names, if she starts to get redemptions, or if redemptions accelerate, then you're going to have forced selling in something that is highly illiquid, which will then create what we in the industry like to call gaps or air pockets, when you're thinking about where this is really going to go. I know, really high tech. So when you think about the air pockets that can come in, where there's just, you essentially have a buyer strike, where you have nothing but sellers and nobody on the other side, because you know that there is just a slug of new volume coming into the market. Now, when you take the SPAC angle and you think about just the way that the shares are created, the founders are essentially getting an undue reward for really doing nothing. You might say that, well, they're getting a reward because they found the company, or they found, some of the, what's coming next. But when you look at it, they issue the SPAC with the intention that in the future they will find a company. Like typically in the past, the company, the asset, but instead of going through that process, you issue the SPAC and then you back into it. But here, because everything's so frothy, because everybody's trying to latch onto this liquidity, they're doing it backwards, and creating the SPAC and then figuring out what they're going to invest in after.
So I just finished a podcast with someone on energy advocacy, and in particular for low-income houses. And so we talked about it, and it's a very challenged, nuanced issue, lots of social justice, and if you want to have a long listen, it'll come out next Monday. But the important part of that question is, like, it seems that the SPAC is similar to 2000 with pets.com. It seems like I use Virgin Galactic as the example. It had $292,000 of revenue in 2020. It is focusing on space travel, and they're a $6.4 billion market cap. And Chamath, who his social capital company is the one that brought them public, just cashed out a north of $200 million of options for a company that has $292,000 in revenue. Like, I don't know what rules you need to apply, but how are fiduciaries investing in these companies? Like, why is that not a private company that private guys can buy and that they can take public? It just seems insane and illogical that of all the things the Fed have done that I think are stupid, this one is like right at the top.
So when we look at, and we're actually going to cover it in the economy show, is looking at just the growth of retail trading. And the problem is you have people who are getting stimulus checks, and depending on your age, is about 60% of that is going to find its way into the market, and it's a marketing game. So how do you market yourself, and how do you try to show that, oh, look at us, we're looking towards the future, we're not investing in the present, this is a future view. And they're taking that and they're really going after this retail money that, not to belittle anyone, but they really don't know as much. They haven't been burned before, as people that have been in the market forever can attest to time and time again, where you think that something's great, you drink the Kool-Aid, and then boom, it's gone. And when for anybody who's ever invested in energy and shale companies, everyone has caught their wrong way on some of these different assets. So when you look at just what is happening, like my wife read it and a headline to me, she was like, "So, Mark, did you know that there's going to be a space hotel in 7 years?" I was like, "I didn't. News to me, but okay." She's like, "Yeah, apparently it's a thing now where you're going to be able to stay in space." And I was like, "Yep." I was like, "That sounds about right. That'll be a SPAC soon, if it's not a SPAC already." And it's this view of just trying to get and speak or talk a really good game for this retail money that is showing that it has a strong willingness to come into the market and invest in some of these growth names without real view of what are the underlying fundamentals.
So you raised stimulus last week. $1.9 trillion of stimulus was passed on the back of $900 billion of stimulus that was passed in December. On the back of, we now have north of 90 million total vaccinations done. I did a little informal poll on LinkedIn. It looks like 63% of adults are going to take it. 37% are not, which means kind of by mid-May, everyone who wants their first shot has it at the rate we're going. Mm-hmm. And we continue to inject massive stimulus, and other polls are saying some of that stimulus money is just going to go right in the stock market. Right. What are we solving for? What was your takeaway from stimulus? Like, when does it stop? When do we unwind? Was this a good decision, or is this just momentum? And what does it do for the U.S. dollar? I know we talk about it all the time, but it's mind-boggling.
It keeps coming.
It keeps coming.
So it keeps coming in waves. So when you think about the stimulus, you have to weigh it with what is the missing GDP level. So when you hear people talking about overheating, it's the view of what is the slack in the GDP number, and you can measure that by manufacturing and other different metrics. So when you talk to some of the economists out there, they're going to say that 900 billion would have been enough to close the slack in the GDP number, especially given where the trends are on manufacturing, ISM, PMIs. So then when you take in the 1.9 trillion, you're going to actually overshoot where we were in GDP, and then you risk an overheating event. And what is overheating? What does that mean? Because everyone likes to talk about it. So when you're thinking about overheating, the view is that you're putting too much money into circulation on different levels. So, we still have the Fed issuing, buying bonds, putting $120 billion into the market every single month for the foreseeable future. And now you have 1.9 trillion coming to market, which is based on all of the numbers that you threw out there. This is going to cap off 6.4 trillion that has now come into the market, 6.1 to 6.4, depending on whose estimates. But given, what's 300 billion amongst friends at this point. So when you're looking at just the amount of money, now you're starting to come into the issues with inflation, the issues with where are these dollars going, and that's when you start coming into the overheating side. Now, do I think this was too much? Yes, I think this is something that we're already seeing it. I was having this conversation this morning. 12% higher for shipments to my house. Now we're talking about, gasoline has gone from $31 to fill up to $43 to fill up as of yesterday. And you're starting to see this creep in as we've talked about inflation. So the benefit of where this is going and how this is being directed, and we've had these conversations before, when you break things down into those quintiles, the top two tiers have done very well. And that's where you're seeing savings. Their costs are going down because those two groups, they're the ones that fly. They're the ones that go to concerts. They're the ones that go to football games, baseball games, and whatnot. So they're not spending. So that money is going into savings. But those bottom three quintiles are living off of savings or are struggling already. And the jobs data continues to show that with much less full-time, way more part-time. These people, and this is measuring who wants to work full-time but can't. And that's where, but at the same time, as you're giving these people money, it's not going as far because now you have inflation catching up, you have prices going up, and you just don't have wages keeping pace. So you're just replacing what they've spent out of savings, but you're not really moving them along, which then leads into what is going to happen with I think we're up to $4 trillion now in the infrastructure bill. I think that's the new number that has come out.
Well, so let's talk about the infrastructure bill because it's just more. What is the infrastructure bill?
So the infrastructure bill, and we covered it last week, and we're going to cover it again when we look at just the shortfalls of where the government has been investing. So when you look at the last decade or so, the government has really fallen behind on investment in infrastructure. This is anything from roads to bridges to national ports. Anybody who's ever flown into LaGuardia can argue that this is well overdue. But when you start looking at some of these components, there's a problem where the non-discretionary spending of the government has risen to all-time highs, and this is everything from unemployment benefits, Medicare, Medicaid, other types of things where we keep seeing that go higher and higher, and the money has to come from somewhere, and it's coming from infrastructure spending. So the idea is to close that gap. Now, I am a proponent of investing in infrastructure because why give someone a one-time check when I can give them a job and a new skill? And I think that is something where, and make the stimulus smaller and then make the infrastructure bill something more focused that will yield dividends for the next 20 years, something similar to, obviously on a different scale than what Eisenhower had when you looked at what Eisenhower did with the interstate system and just how many dividends that has paid over the last 70 years.
So you raised oil, which again, when it comes to infrastructure, we're moving products, we're moving goods, we're going around the world. Over the weekend, we saw a number of missile attacks by the Houthi rebels on Saudi Arabian infrastructure, which is thought to be Iraqi-backed. We also saw the OPEC meeting where they didn't raise production, and we saw oil really move to 66. I think we've seen a little bit of softening as there's been some profit taking because the move has been so incredible. But what was your takeaway from the OPEC meeting, and why are people not as worried about the geopolitics of these Houthi rebel attacks again as maybe we thought they were going to be going into Monday?
So when you look at what happened in 2019, when you had the killing of Soleimani, and then you had Iran launch ballistic missiles, but we know that they originated from Iran, targeted U.S. assets. But there is a difference between a ballistic missile and a rocket, and that's something that always has to be clarified because some people use them interchangeably, and they're not. A ballistic missile is an intelligent piece of equipment where a rocket is launched. I mean, don't get me wrong, the U.S. and our allies and some of our potential not allies have smart rockets, but these individuals are launching rockets from shoulders, from the back of pickup trucks. These are not intelligent components with laser guides. A ballistic missile is something intelligent, is something that really shouldn't miss unless it's shot down from an anti-missile asset. So when you think about rockets versus missiles, we see time and time again, Baghdad, the Green Zone, rocket attacks. That is something that is smaller, but a ballistic missile is a bit more aggressive. And when we look at what happened in 2019, the idea is that they missed on purpose, or they were just sending a message, but there was really no point of escalation. And that was a big walk back. And that was when we saw the peak in oil, and then we really fell off from there. And then obviously everything else came into play. Now fast forward to today, and you have the Houthis that are claiming that they launched these things. Did they come from Yemen? It's probably unlikely that they originated from Yemen. It was most likely from Iraq and or Iran, depending on the trajectory in which they actually flew from. But they were also shot down fairly simply from F-15. So the question is, what was the intelligence of them? What was the direction? And was it just a shot across the bow without a real means of waking up? And as we've talked about previously, and that we're actually going to cover it again, and I'm going to write an article for Hot Take of the Day in War Room, looking at why Iran is doing this from a point of weakness. You know, I said about 8 days ago that Iran was going to react strongly because they're facing uprisings within their country. So they're seeing uprisings on the border with Pakistan, and this is creating some strife of, well, how much control does the regime have? And in order to mitigate some additional uprisings and having this spread, they're going to project power. They're going to project that to their proxies, the Houthis in particular, and to others that we're still here, you still need to pay attention to us, where it's different when you're being aggressive and you have the backing of your people, and another when you're trying to project something that is failing at home. And that's where I think we have to look at this differently, which is why it's not being considered on the same level as even it was back in 2019.
And so that fed into, or came on the back of, an OPEC decision where, you know, we've seen, I think OSPs came down. There's lots of questions about physical demand versus actual demand. We didn't actually knock off any infrastructure. And yet here we are with oil at 66. And many of the bulls that are running around Twitter, because that's what they do, are talking about $70 oil, $80 oil. What do you make of OPEC's decision? And to me, it was a smart decision, but it's going to come with consequences in that when that oil comes back, or people actually see how weak the market appears to be, that there's some gaps. What do you make of that?
So when you look at what was agreed upon, so Russia is going to bring 130,000 barrels to market. Kazakhstan going to bring 20. So in total, that's 150,000. If you show what Libya is bringing back, you're getting at about 250,000 barrels a day between the February number and the April number. So again, it's something that when you can take it from two different perspectives. One, Saudi Arabia and OPEC wants to continue to try to draw down some of this excess capacity, even though we have seen a increase in floating storage, and you're starting to see that soften up in Asia. Or they're looking at what we're looking at when we talk about physical market. And when you consider where the physical market is, like right now, as we've been talking, actually, Sand & Gold cut offer price on one of their April cargoes against dated Brent. And when you start looking at some of these factors of, well, why is the physical market getting so weak? And then you look at what's happening in China. China has slowed down their purchases through February so far. And they do have a very large, or a fairly large, turnaround season coming up in April. So why would you want to run the market ahead of a turnaround season? We had big disruptions in the U.S. that are still limiting the amount of capacity coming into the U.S. markets. And it's just that's where we're starting to see some of this difference in some of this physical market. So I was surprised. I thought they were going to try to cool the market a bit more. They could have done that more with OSPs, but they didn't, or official selling price. And India is responding with something a bit more aggressive, talking about, diversifying, which, you can only do to such a point, because they've seen gasoline and diesel prices reach all-time highs. And then when you start looking at China, they're at a multi-year high in terms of crude and refined products and storage. And this is where we're starting to see some of this bifurcation in the market. And now you have WTI down $1 to about $64 as you get some of this softness coming in, but that's on the back of a stronger dollar. Some of this inflation slowing demand, and then the physical market starting to get a bit more airtime.
So much going on. You can do deep dives in all of this by getting the Primary Vision weekly videos, and also by subscribing either to War Room Media or Hot Take of the Day for Mark's weekly column, where he does a big deep dive into a single subject. The last question I wanted to do, we have Biden is almost at 60 days. And again, depending on your media source but he hasn't done really any Q&A from reporters. It seems incredibly protected. And notwithstanding that he has a stutter, and this is not making fun of our president. He is our president. He is my president. That's the way that it is. But he looks like his mental capacities are failing at a incredibly rapid rate, just based on the clips that I've seen. Are you seeing that, hearing that? Where does that go, and how does that overlay all of the other things with some of the geopolitical issues? I mean, I wouldn't want that job, and I think I'm pretty sharp. I would not want my faculties failing and have to run the most important country in the world.
Right. Yeah, I think there's a mixture of two things. Is one, there's a lot of fact finding right now, and when we look at trying to understand what our supply chains look like before we go into now we're supposed to meet with China and Alaska to have a review of what our relations look like. And now I think it was March 25th is now set for looking at federal land leasing on oil and gas. Right now, I think that there is a lot of this 100-day view of let's gather information, look at the 100 days, and then go before the media and say something and say, look, this is what we found. This is what my plan is going to be. This is what the administration is going to focus on. And this is how we're going to target that. So that is that is the optimist side. That is what I'm going to say if I'm an optimist, and say that, look, this is what they're going to do. You know, in last week's write-up, I talk about, you know, what does the supply chain review look like, and what's the point of it? And I think that there's something to be said about that. But then the other side is, are they trying to understand how much time he can have? You know, what is the kind of capacity that he's willing to move at? And is there something that he needs to consider when you're looking at some of his recent fumbles, if you will, in front of the media, when you consider about, you know, what are his faculties? And I think that there's always going to be this pushback of every time we have a new president, some of our enemies or some of our individuals that we have some strife with like to push boundaries, see, okay, well, how hard can I push on this string until it slaps me back in the face? And that's why I think it was important that we struck in parts of Syria against Iran after their impacts against Iraqi holdings and where NATO troops are. I think it's going to be important to come after and show strength against China. And now, while Biden is one thing, there are a lot of people that he has, Catherine Tay being one of them, who's fantastic and who's been great at being tough on China. So I think he also has some smart people in place to help mitigate maybe some of the issues that he's facing in terms of his ability to get his message across in person.
Well, that is a great hedge, because I would say certainly, regardless of your affiliation, you would say maybe 2016 and 2020 didn't use the best of America in terms of advice and counsel, and it was sort of a one-man show, and so now maybe the president is less important. What I do know, having been watching Designated Survivor, is there's a lot of really good things that Kiefer Sutherland could do if he was president of the United States. So we will leave the pregame show there. I am David Ramsden Wood. For Mark Rossano, we thank you for joining us, and we will see you next week. Bye for now.
Thank you.